Good evening and welcome to the webinar tonight. I am Shelley and I'm a financial advisor at Enable Me. Financial advisor, money coach, help people be better with money. That's what I do. Now, you might be here tonight because you have a fixed mortgage that's coming off a horrible interest rate. You might be here tonight because you're floating in anticipation of that OCR announcement on the 19th of February. Or you might be looking to get on the ladder as a first home buyer and taking on a mortgage for the first time. Either way, you're in the right place because that's what we're covering off tonight, how to master your mortgage. So to set the agenda for the session tonight, I'm going to start with some bad news, some sad realities about having a mortgage and buying a home in New Zealand. I'm going to talk about some of those things that are external to us that we might feel are holding us back. I'm going to talk about money behaviors and money psychology tonight and how you can hack yourself to be better with money. I'm going to talk about your money mindset and how important that is as part of a plan. I'm going to share a couple of stories, and if we have time at the end, a little bit of Q&A. So there've been some great questions that have come through already, so hopefully we get a chance to answer some of those. But if you feel a burning desire to ask a question during the session tonight, there should be a wee Q&A box or a little comments box or a chat box that you can put your questions into. So fire away, and we'll hopefully get a chance at the end to answer some of those. So as always, our webinars are just general information. If you feel like you need tailored financial advice, come and see the team at Enable Me. Today, it's just about information, not a specific tailored financial plan. So a little bit of background about me. So while I appear to have it all together in terms of my finances, wasn't always that good with money. So I confess to having credit card debt prior to working at Enable Me. And it just creeps, doesn't it? And by the end of the year, it would just be a little bit higher and a little bit higher, not quite paying it off every month. But since I started at Enable Me 9 years ago, I feel full of financial confidence, and I love to translate that across to my clients. So my job as a financial personal trainer is really just to help my clients get ahead faster, save more, feel in control, get a plan, grow your wealth, and ultimately be sorted for the long term. So that's what I do, and I love it. So thought we might just start tonight with a little poll. So it's going to flick up on the screen shortly, I think. I want to understand who's on the call tonight. So a couple of different options here. It might be that you're a first home buyer, you're looking at getting on the ladder. It might be you've just got on the ladder in the last couple of years, which may have been feeling kind of hard, and you've got between sort of 20 and 30 years left. Or you're well established as a homeowner and you've been dealing with mortgages for a number of years. Maybe a couple of you are mortgage free, let's hope. So I'll give you guys a second just to make your choice. Do we have the answer to this, Olivia? Okay, a lot of you. So 44% of you have more than 20 years left on your term, and 39% a little bit less than 20. Okay, so kind of right in that middle bracket, actually. Oh, 3% of you are mortgage free. Congratulations. Thanks for that, Olivia. Shall I close that off? Perfect. Okay, so let's get into it. So yeah, last year and the year before, a little bit hard, weren't they, team? There was a common saying of thrive to 25. We tried to help people not feel that they were just surviving. But this year it's all about thriving in 2025. What we're finding at the moment, and this is a little bit sad, is that 49% of New Zealanders' income, of the average New Zealanders' income, is actually going towards their mortgage. So when you think about it, whatever's coming in, half of it's going on mortgage payments. So what that means is the rest of your spend gets squeezed. And ultimately, we have to pay our bills, we need to eat, and if we have children, we need to feed them. All of those kind of fixed costs still remain. And in the last couple of years, they've gotten higher with inflation. So unfortunately, what tends to get squeezed is what we call your discretionary income. Discretionary income is things you spend your money on that are a bit more fun. So that gets squeezed the more that's going to your mortgage, right? So not very fun couple of years, and not fun when half of your income is going towards your mortgage. So that's the first issue. 59% of Kiwi mortgage holders are actually suffering from mortgage stress. This is not necessarily can't make my mortgage repayments. It's just those sleepless nights thinking, oh my gosh, my mortgage is too high. I'm never going to pay it off. I might be coming up to retirement. That's a sad statistic. 80% of mortgages, however, are coming off their fixed term this year. So while it's been a tough couple of years, there is some hope on the horizon. What's happened over the last 10 years? And when you think about it, 10 years is a very short period of time. The average first home mortgage in that period of time has actually increased. You could say almost nearly doubled from 300K to 550K within the last 10 years. So for those of you that have gotten on the property ladder in the last 10 years, it's probably feeling a little gnarly right now. So it's definitely getting harder and it's definitely getting more expensive. When you think about it, the interest rate is a percent, right? So a percent more on 550 hurts a lot more than a percent more on 300,000. So definitely times are tough. We want to feel financially secure. And why do we want to feel financial security? In my mind, being financially secure gives you choice. It gives you the ability to sleep at night and not worry about money and mortgages and how we're going to pay our bills. For some of us, financial security looks like having the mortgage under control or completely paid off. So we actually have choice around the work that we do, choice to follow our passion, pick up a hobby and be able to pay for said hobby, or just to be honest, to feel stable over volatile times. And I think actually coming up 5 years since that first level 4 lockdown. So if there's anything that taught us, it was things can turn volatile really quickly. So to be financially secure weathers us against those storms that can happen that we can't control. So the reality in New Zealand, and there's so much that feeds into this, I never get political. It's not that, it's just the way it is in New Zealand. We're paying too much interest on our mortgage. And sadly, because a lot of our banks are not owned by New Zealanders, a lot of the profits that our banks make go offshore. So the extra interest that we're paying to the bank is not even staying in New Zealand. So in my mind, that interest that you're paying on your mortgage could be put to much better use. For a start, it's a retirement. Often I'm saving hundreds of thousands of dollars on my clients' mortgages. That's a retirement. It could be that you want to have an overseas trip or, take the kids on experiences. For some of us, we want to pay for our children's education, possibly help them onto the property ladder, and just to have more choice in general around what we do. So it's interesting. And we sometimes get clients who become kind of obsessed with interest rates. And rightly so, because like I said, a percent more on 550, it equates to a lot. And it's squeezing you in terms of like the fun money, right? So I wanted to do this example of if we took a mortgage rate of 5.99% over a 30-year term on that average $550,000 mortgage, how much interest are you going to pay? So the far left-hand top blue bubble is the calculation on a 5.99% interest rate. You would pay more than double back to the bank, 635,000 in interest, let alone the principal. If you put rates at 5%, so just about a percent lower, it does make a huge difference. So on that same 30-year term, you're saving over $100,000 in interest that you don't pay to the bank. Tricky thing with that, can we guarantee that you're only going to be on a 5% interest for the 30-year term of your mortgage? Historically, 5% is actually a good rate. They can go higher. So yes, getting a good interest rate is great, but the thing that's going to shift the dial the most is paying extra principal on your mortgage. So if you can find some money, and I know that's hard, but I'm going to talk to this in a second, and you can channel that towards your mortgage and chop it in half, the interest that you pay on a 5.99% rate is $230,000, $400,000 difference versus $100,000 difference on that 1% different interest rate. So see how that makes all the difference. And if you can get that 30-year term down to 10 years, 181K that we're paying back to the bank on your $550,000 mortgage, huge numbers we're talking about here. It involves extra principal on your mortgage. That is the key. So a lot of us take advice from parents. We might take advice from an older sibling that might have got on the market 10 years before we did. We might even be taking advice or listening to our grandparents. If there's one thing that we know to be true, it is much harder now. Why is it harder? The average, the debt to income ratios, that's the number of times that your annual income goes into your mortgage, is much higher now. So it's much, much harder to get on the property ladder. It's actually harder to get lending now. Once you've got on the property ladder and got a mortgage, it's harder to get mortgage free on it, let alone retire comfortably and help your children out. But just because it's hard, that doesn't mean we should shy away from it. So, what can we do to be better? A lot of us have this thing where we blame, I'm not going to use the word victim, we blame external things for us not getting ahead. And I'm talking about a money sense. So for some people, they like to say, oh, the government changed and they changed this rule, and now the investment properties, it's not as good now anymore. They're going to introduce capital gains tax, so we're never going to do that. You know, for some of us, we think, well, we're in a recession at the moment. It's hard. We can't make progress in a recession because everything's hard, so we can't make progress. For some of us, there's increased competition in the labor market. Interest rates are high. I know it's hard. Some of us think they just need luck. And as soon as I go through my clients' budgets and I see lotto sitting in there, I take it out immediately. We enable me as your lotto. We're not relying on luck to get us ahead financially. In my mind, control the controllables. And what is that? Look inside yourself, look at how you behave around money, your money psychology, and aim to be better. When the going gets tough, we just need to get smarter. So just because things are hard, that's not a good enough reason to not try. And in my mind, just sticking with your current trajectory isn't good enough. When clients come to see me, I often say to them, look, you're not here to just do what you've always done. Clients work with a financial coach so they can be awesome financially, so they can create opportunity for themselves. A sad fact for me is that 135,000 Kiwis over the age of 65 still have a mortgage. That equates to 25.2 billion of current mortgage debt for those over 65. Something's happened along the way for that to happen. They certainly haven't sharpened up if they've still got a mortgage at age 65. Something's happened. But that's a very sad statistic, and it's something I want to turn around. So there are tailwinds coming. For some of us, they have already come. We like to say that there's a little bit of hope out there. Conditions are starting to improve in some regards. We are still in a recession. Interest rates are still high-ish. A lot of us still have those interest rates fixed at quite high rates. For most people, they're coming to me, they're in the late sixes. So conditions are slowly getting better. In my mind, let's not wait. We need to just start taking action now. One of the biggest pieces of feedback that I get from clients who come to see me, they get really excited about their plan and they say, I should have done this 20 years ago. I'm like, I know, you should have planted that tree 20 years ago as well. But the second best time to plant a tree is now. Action and execution is key. So let's not talk about timing an interest rate drop, playing banks off against each other to get a better interest rate, or just doing the whole ostrich treatment and kind of hoping that things will work out. There are some levers that we can pull to help you get ahead faster, and I'm going to show you how. So it first starts with looking within. So instead of worrying about what's going on around us, things that we can't control, look within yourself and go, okay, how do I behave around money? What is my risk appetite? Am I risk averse? Is that holding me back? Should I be investing at a higher level? Or am I overly risk tolerant and I'm actually taking silly risk? We start to look at understanding your willpower or your stickability. How likely are you to stick to a plan based on your particular personality type? And what are those triggers that take you off the path, off the straight and narrow? What we know to be true and what we believe here at Enable Me, earning more does not translate to getting ahead faster. And believe me, I've been here for 9 years. I see this all the time. My worst offenders are my bigger income earners. They feel they have the right to not worry about money. It's almost like the more they earn, the more they feel they deserve to spend. And like most people, this is just human nature. They do the whole lifestyle creep thing. So the risk with that, not necessarily a bad thing in itself, as long as you're still saving, But if you're not saving and you haven't got your eye on the longer term plan, very hard to correct that high level of spend when the income stops. So earning more money does not translate to you getting ahead faster. It helps. Earning more money is great, but live within your means and ensure that you're having that level of savings to get you ahead in the long term. So we believe financial success to be 20% the plan, the strategy, 80% it's behavior, it's action, it's stickability, it's willpower, it's making sure that it actually happens. So when we meet with clients for the first time, we look at their starting point. For yourselves, you could look at, hey, what do we own in terms of our house, if you are on the property ladder, and what do we owe? The difference between the two we call your net equity or your net asset position. So what is the value of your home less the value of your mortgage? That's your net asset position when it comes to your home. If you've got debt, how much is that in terms of short-term debt? Do you have any savings or any investments? What is your starting point? Once you know your starting point, and a lot of people don't, once you understand that, look at your end game. Where do you need to land? What is the term on your mortgage? Has anyone actually stopped and said, actually, my mortgage has 27 years to run and I've only got 24 years before retirement? That doesn't compute. Jump on your banking app, look at the mortgage details. How long is your mortgage term? What is your default trajectory? How long do we have until you want to have choice around the work that you do or until you want to retire? So what is our kind of time frame and our game plan? What are your tendencies? And for some of us, just what is the hand you've been dealt? For some of us, we're lucky enough to have generational wealth. For most of us, we inherit a work ethic, sadly. For most of us, it comes down to three things. Maximize your savings. Boring, I know. Save more. Earn more, spend less, save. Easier said than done. I'm going to show you how and give you a few tips. But step number one is maximize what you can save. Step number two, sometimes an unpopular opinion, but here at Enable Me, we believe just get rid of your home mortgage. Crush that thing, get it gone as quickly as possible. I actually saw a new client the other day for the first time and kind of not where they should have been. They had kind of a big mortgage. Their net asset position wasn't where they should have been for their age and stage. I challenged them a bit on that. I like to be a little direct. And they had this idea about investing. In my mind, they weren't even on track to get mortgage free before retirement. So I kind of had to tell them some uncomfortable truths about their situation. And my recommendation to them was, hey, investing is great. And you're doing that with your KiwiSaver, but we just need to get rid of that mortgage as quickly as possible. That's going to unlock opportunities to grow your wealth before you get mortgage free. And I'm going to talk about that a little later. So first step, kill your home mortgage. Sorry, second step, kill your home mortgage. For those of you who have investment properties, I'm not sure if anyone on the line has those, we want to prioritize killing your home debt ahead of your investment debt. So kill your home mortgage is step number two, and build wealth. We all need to build wealth. Why do we need to build wealth? At some point, you want to stop working. So when you want to stop working, we need to have something to live off. You have no choice but to grow your wealth. And here at Enable Me, we believe in the power of leverage to help you grow wealth faster. So how do we maximize our savings, Shelley? It starts by strengthening your financial foundation. And to be honest, this is where we start with all of our clients, even the ones who are kind of a little bit further ahead than you might think. Address your money habits and your behaviors and the way you manage your money. Think about what your goals are. So for some of us, we actually just float along in life and we're kind of on that hamster wheel. We don't really think about what do we want out of life. It's unbelievable the amount of times I say to people, you know, what is your goal for the future? Paint me this beautiful picture about how you want your life to be. And they're not able to tell me, which is weird. For some people, they are very certain they want to get mortgage free within a certain time frame. They want to retire within a certain time frame and they want to help their children. But sit down. If you're in a couple, sit down, talk to each other about, hey, what are we trying to achieve here out of life? Don't think about the financial numbers around it. Just think about what those goals are. Really important, particularly for our more shopper type personalities, to have a really strong goal. That's the thing that's going to keep you motivated with the boring stuff like budgeting and savings. So identify those goals, critical part of any plan. The cash flow management piece is just having the right system. So we lean on the wisdom of James Clear. He's written a book called Atomic Habits. Make sure that your money habits and the way you manage your money ensures that the default position is that you get ahead faster. And of course, restructure and pay down your mortgage faster, right? And we have a special way of doing that. When we're talking about behaviors around money, and I find this fascinating, we talk about your spending personality, we start to understand your risk appetite, your willpower tendencies, your triggers. We start with how much are you saving at the moment, and then we like to stretch you to see how much you could save if you were to really get intentional with this plan. We like to think about where are those inefficiencies happening? Is it in your mortgage interest? Are there other forms of fritter that we can find in terms of where your money's going? And that's what we call your cash position. So the first port of call is the money personality, your spending personality. So your shopper, they're having a lot of fun. When I have two shoppers in a couple, they're having lots of fun, but they're not really going anywhere very fast, financially speaking. At the other end of the spectrum, you've got the saver. Sometimes with my savers, they get a little obsessed with savings and they forget to lift their eyes off the road and think about long term where they're headed. And the plot is kind of in between. They're not particularly enthused by spending money. They're not really saving at all or saving as much as they should. And for my plotter clients, they tend to need a bit of a push. They can tend to stagnate. So once we understand your spending personality, we start to look at how you behave when it comes to risk. Sometimes I say to my clients, if I was to say to you, I think you could buy 2 investment properties in the next 5 years, the look of horror on their face, I know they're a safety warden. I know that they're very risk averse. For those that are more that adventurer type, the more risk tolerant type, they tend to go, yeah, bring it on. And then you've got the dreamer who kind of feels like the universe will provide. Sometimes it does actually, which is kind of annoying. But for me and any of the other type A's out there, you got to get a plan. Let's not wait for the universe to provide just in case it doesn't. So once you understand your risk appetite, your money personality or your spending personality, we start to look at how likely you are to stick to the plan. So a couple of different personality types here, and you can actually go online and do a quiz. If you search up for tendencies, you can do the quiz to understand which personality type you are in this regard, but it relates to how well you're likely to stick to something in general, whether or not that be a financial plan, whether that be weight loss, whether that be exercising more, how likely are you to stick to a regime? So most of us fall in the two middle options, your questioner and your obliger. An obliger must have external accountability. They actually thrive on someone else telling them what to do. They tend to please other people ahead of themselves, and sometimes that involves spending money on others and putting themselves last. So for my obliger clients, it's almost like I sometimes give them permission to be financially okay for themselves, and they must have those targets, and they will move heaven and earth to hit my savings targets or my debt reduction targets that I set for them. Questioners need a lot of information, a lot of time, and a lot of analysis before they will be motivated to act. So if you come up as that questioner type, the risk with questioners is that they can sometimes get paralysis by analysis. And if we're talking about a saver, a plotter, and a questioner being your money personality, you are going to have a major paralysis by analysis issue and you're likely to not act. And as we know, it's all good knowing what to do, but knowing and doing are quite different things. The key is in the execution. So I worry sometimes with my questioner clients. They take a long time. They're very skeptical. They need a lot of data. So it's kind of giving them the information and the space to overcome that so they can take action. In terms of the other two personalities, they're less common. The upholder tends to be very disciplined. They probably don't need us. Sometimes they actually need permission to spend, I find, my upholder clients. You know you're an upholder if you feel a little bit let down by others. They're not meeting your exacting standards. And rebels, well, yeah, they're often having fun. Don't tell me what to do. I'll do what I want to do. That's a typical rebel. So once you've got that money personality stuff sorted, what is your actual cash position, your starting point? So would you consider yourself to be floating along? That kind of applies to kind of the majority of people. So money comes in, it goes out again, but we're not really saving. That's what we consider to be floating. The sinking means you might not be paying off your credit card every month and it's creeping. A little bit like what I did 9 years ago, starting with Enable Me and understanding a plan. If you have short-term debt, you're definitely sinking. Ultimately, we want all of our clients to get towards being flying financially. So understanding your starting point and your natural tendencies around money can help you to optimize your cash flow and find that surplus. So here at Enable Me, people come to us and they go, well, we just can't possibly save. Money comes in, it's cost of living in New Zealand is so expensive, we just cannot possibly save. Rubbish. We can find that money. And we have coined a term here at Enable Me that we call fritter. And we believe, it's a bit of an estimation, but we believe that most Kiwis fritter around 15% on average of what comes in. So to keep the math easy, if you're earning $100,000 a year, and that's what's coming in after tax, we believe you're frittering $15,000. You might think, but how? So having your mortgage structured not the right way, paying too much interest to the bank, huge source of fritter. Remember the slide from earlier, 600,000 of interest to the bank versus 235? Massive source of fritter. So let's get that mortgage structured correctly. Food is a really big source of fritter. So it could be getting a takeaway because you can't be bothered cooking at home. It could be going back to the supermarket for the 7th time that week. Too many online subscriptions, too many bank fees, and just that lazy tax of not really reviewing your fixed costs like your insurances and your power bill. And you could get a better deal elsewhere. So lots of little things across the board that actually add up to exponential gains, because you think 15% of your net income per annum times the number of years you have before retirement and the compounding effect of the interest on that adds up to a heck of a lot. So find that fritter. So we like to refer to this happiness graph here at Enable Me. And we usually use a coffee analogy when we do this, but I decided today that I'm going to use a sushi analogy. So for some of us, we go into the office every day. We kind of feel like it's our right to go and buy our lunch. There's a sushi shop down the road. It's delicious. It's that kind of carb hit of the sweet rice, karagi chicken. It's amazing. Say on a Monday, you buy your sushi from the sushi shop. Great, amazing. I've been making my lunch all weekend. I'm going to work. I deserve this sushi. Feels good. You're super satisfied. On Tuesday, you go back, $20, $15, whatever it is. It still tastes good, but you had it yesterday, so it's maybe 80% as good. Say you go back on Wednesday, you're kind of all sushied out. So your optimal level of sushi consumption for the week is 1.5 packets of sushi. Anything that you've spent on extra sushi packets throughout the rest of the week, we would say is fritter. So let's not do it. Let's just do the one sushi per week. We're going to be happier and we're going to be saving money. So that's how we describe fritter on our happiness graph. So step number 2 is kill your home mortgage. So crush that home mortgage. Again, if you've got investment properties, we want to put them on interest only, prioritize paying off your home lending. It saves on interest to the bank. It unlocks opportunities. I wanted to address some questions that a lot of you on the call are probably thinking at the moment. And if you're anything like a lot of our clients and you've had a mortgage rollover onto a floating rate, I know it hurts, but a lot of you might be floating in anticipation of the OCR announcement on the 19th of the month. So you might be floating, you're wondering how long you should fix for. Some of you might be thinking, should I be structuring my mortgage better to pay it off faster? And actually, what am I capable of achieving? Like, how fast can I pay off my mortgage? So for me, it's less about the interest rate and it's about the pace that we accelerate paying off our mortgage. Put extra principal on your mortgage. It's going to get you ahead faster than worrying about interest rates. So a couple of different options with your mortgages. So if you're floating at the moment, one of the options is to simply refix. Your fixed loan, it's finished its term. You might negotiate rates with the bank, get 0.5% off if you're lucky. You could just refix. Another option if you're floating could be to actually shift to a different bank. So a refinance might look like negotiating a better mortgage term. If you have an investment property, you could do split lending across that property and your home mortgage. That can be an advantage to refinancing. You might refinance to get the cash contribution. And for those of you that don't realize, some lenders, depending on the lender, depending on the banking environment, might actually give you a decent cash contribution. Could be between 0.5 and 1% of the value of your mortgage. If you're up there in terms of your mortgage balance, that could actually be really compelling. So some of us might move to get some cash out of the bank and negotiate better terms. What we tend to lean into at Enable Me is more optimizing the mortgage, restructuring, whether or not that's with a new bank or your existing bank, to allow you to pay the mortgage off faster, but doing it on your terms, not on the bank's terms. So I'm going to talk about, and I think it's on the next slide. Yes, so revolving credits and how they compare to offset mortgages. So once we've established you can save and you have the systems, you've minimized your fritter, and you actually are habituating your saving, we want to channel that down to paying off your mortgage faster. So here at Enable Me, we lean into getting our clients with a revolving credit. For those of you who don't know what a revolving credit is, it's kind of like a floating loan that you can pay amounts into, but then you can take that money back out again. So it's very flexible. So a revolving credit, we can use that to pay the mortgage off faster, but then you can actually re-access that money in an emergency. So it kind of acts as your emergency buffer as you're paying down the mortgage. The cons of a revolving credit, and we caution revolving credits unless you're actually working with a coach, because when you're trying to DIY paying your mortgage off with a revolving credit, where people go wrong is they float too much within that revolving credit, and you're paying a privilege to float. And the floating interest rates, as we know, are a lot higher than the fixed interest rates. So one of the cons of a revolving credit, we sometimes call it a revolting credit, is that if you don't have good systems, if you need accountability and you're not quite paying that off in the time frame you should, you end up paying a privilege to float. So let's not do that. So an offset mortgage, I often get this question from my clients. We tend to prefer it less than a revolving credit. For those of you who don't know, essentially you have a floating loan where you're making repayments, and then you have a savings account, and the savings is essentially offsetting the interest. So you're essentially paying 0%, but you're still making mortgage repayments. And this is where I prefer the revolving credit more, because actually with a revolving credit, they only charge you the interest on the balance owing. There's no fixed term repayment. And actually, once it's gone, it's gone. With an offset mortgage, that fixed term, you're still making payments on at 0%. Ultimately, we just want the mortgage to be paid off. So let's get rid of it. So cons with an offset mortgage, it actually means that the money that's sitting there, essentially, we could pay that mortgage off and have lower fixed repayments, so we can then channel into paying extra debt off or investing elsewhere. Sometimes an offset can be beneficial if, say, you're self-employed and you have tax money sitting there. Sometimes we have we offset loan where that tax money or maybe money from a family member can sit in a savings account and give you a bit of an interest win. In my mind, my preference is revolving credit, but make sure you're careful with revolving credits. You must pay off the amount you have floating within a 12-month period. So don't float too much within a revolving credit is the key. So plot twist, being mortgage free is great. And I've helped so many clients across the years become mortgage free. You're here because you want to understand how to be better with your mortgage, how to structure it better, how to pay it off faster. But actually, it's funny. Once that mortgage is paid off, it's kind of like, now what next? So paying off the mortgage is great, but actually, what are the opportunities that we're creating by paying the mortgage down faster? And how can we tap into those opportunities to grow our wealth? So step 3 is starting to build your wealth. And like I said earlier, we kind of do have to build wealth because ultimately one day we want to stop work. We here at Enable Me believe in the power of leverage. Why is leverage so awesome? You can actually leverage, which means borrow, against the equity in your family home. So as you're paying your mortgage off and you're paying that debt down, and I know it's not happening at the moment, but in future, as the value of your house increases, you're creating a beautiful amount of equity that we can then take to the bank and say, hey, I'd like to buy another house as an investment property. You can 100% finance that investment property using that equity you've created within your house. And you can do that before you become mortgage free. So clients often say to me, I just want to invest. I want to invest. I want to do some investment funds and grow my wealth for retirement, which is great. But when you're paying off a mortgage, essentially that means you're channeling all of your savings into that mortgage. And until you're mortgage free, we don't really have much in the way of spare savings. So the beauty of leverage is that we can do it before you become mortgage free, tap into that equity, buy another asset, and now you've got two assets going up in value over time. So I wanted to give a client example at this juncture, and these guys are amazing. This is a real life example, different names, of course. They started working with us back in 2017. They're actually still working with us. When they first started, and they were very typical of an Enable Me client, they were working professionals in their mid-30s. They'd just got on the property ladder. Kind of a big mortgage, 700,000. They had a bit of a champagne taste when it came to the house, but they had a 700K mortgage. They were on a 30-year term. And when you think about it, mid-30s, 30-year term, that's going to take you through to age 65 if that's when you want to retire. So we put together a beautiful looking plan for them. We understood their money behaviors. We understood what their triggers were, how we could offset that, how we could get them ahead faster. The initial Enable Me projection was actually 12 years. So we actually cut it in less than half, saving them thousands of interest. But actually, these guys did it in 4. Incredible. I want to say they didn't have children. That's my caveat. However, if you do have children, it's still doable, but these guys didn't. So they cleared their mortgage in 4 years instead of our projected 12. Along the way, and they're still working with us, they actually had to replace their car, they had to pay for a wedding, and they renovated their house and they traveled overseas. So just because you're paying your mortgage off faster, it doesn't mean that you're not able to have fun along the way. And now they've actually bought 2 investment properties to bridge their retirement gap. I think their retirement number keeps getting higher and higher. We may have to keep buying properties. They're setting their sights higher and higher every year. But this is what these guys were able to achieve by using a coach, understanding a plan, and ultimately sticking to it to achieve it. So I'm going to show you this graph, and I know it looks a little confusing to start with, but I want you to look at the dotted line. So the dotted line is kind of like my client's trajectory. So they were on track to be mortgage free at age 65 on a 30-year term. We did the calculations. Their KiwiSaver was going to run out at age 69. So not to do with those clients, but in this particular example, if we could have got them mortgage free 10 years prior, it improves the baseline, and more, it gives us time after you're mortgage free to start preparing and investing towards retirement. So you can see how that would take you out to age 80 instead of age 69. So paying the mortgage off faster buys us time pre-retirement age to be able to invest towards retirement. And as we know, financial progress is really linear. If you've ever gone back and looked at historical interest rates, at historical rates of return, particularly when it comes to the share market, you'll see it doing this. It's just life happens, and that's why, and we like to say, we prepare an Enable Me plan for our clients, but that plan is a living document. Life, it's not a case of if, it's a case of when something happens to you. So like with any plan, we need to remain flexible. We need to be able to pivot. And we saw this over COVID with our clients, pilots losing their jobs, people going into lockdown. How did we pivot? We reset, we understand what the new plan is, and then we go again. So the financial planning is crucial to this. Like any good plan, we need to understand the problem we're trying to solve. Let's understand your money behaviors and your tendencies, remove any inefficiencies, minimize that fritter. Make sure you have got systems around managing your money. Work towards developing a wealth mindset. And I see this so often. We have clients coming in and they have what we call a poverty mindset or a scarcity mindset. Often it's due to how they were raised. They may have had parents that were worried about money. There could have been, the 87 crash at that time, and there was not much money to go around. It actually holds you back. So we want you to be moving towards more of an abundance mindset, a wealth mindset. How are you going to invest so that you can actually create opportunity and choice and financial freedom for yourself? Again, point number 6, execution is key. And like any good plan, we need to be able to adjust when things go wrong, reset and go again. So I love this quote from Tom Landry. So a coach is someone who tells you what you don't want to hear. And across my 9 years of working with Enable Me, I've been told that I'm very direct, but it always comes from a place of care. And I always say I would be doing my clients a disservice if I didn't tell them the hard things. So a coach is there to help you see what you really don't want to see sometimes, to actually allow you to realize your potential. And another beautiful quote from Morgan Housel: the ability to do what you want, when you want, for as long as you want has an infinite ROI. Financial freedom equals choice. I love that. So, takeaways from the slides tonight. Number one, maximize your ability to save. Find that fritter, understand your money behaviors, understand your habits, and address any bad money habits. Make your money habits just this is how we manage our money from here on in. And the default position is that we're saving, we're paying down our mortgage, and we're on track to be sorted for the longer term. Kill that home mortgage. Step number two, it opens up opportunity to grow wealth, and we minimize thousands of dollars of interest that we don't pay to the bank. And the third step is grow your wealth. Use leverage, understand your investment plan, calculate your retirement number, and use leverage to get yourself ahead faster. So we are going to have time, I think, for a Q&A, maybe 5-10 minutes. Olivia, my producer, is going to pop on and ask some questions. If you have any questions now, please pop them into the chat. We would like to extend an offer to all of you on the call tonight, and anybody who is watching this recording from tomorrow. We would like to extend the invitation for you to come along and have an initial consultation with one of our Enable Me coaches. We normally charge $400 for those sessions. They run for 90 minutes, and we're looking at what is your starting point, how can we hack you in terms of your money psychology, and let's get a plan to get you mortgage free as fast as possible. So love to see you. There's a whole range of beautiful coaches you can come along and talk to. Scan the QR code. If you book tonight, you get that discounted down to $149. Bookings made after tonight, that is still discounted, but it goes to $249. So love to see some of you from the call today. So Olivia, have we got some awesome questions that have come through?
Hi, Shelley. Yes, we've had a few really good ones come in. So the
Fantastic.
first one we've got is if you can contribute an extra $50 towards your mortgage fortnightly, would that make a difference?
100%. I actually, this is a question that came through pre today, and I hoped you would ask that one. Thank you. Absolutely. When you think about that $50 a fortnight, $50 a fortnight is actually 1,300 per annum, which over a 10-year period is 13,000, and over a 20-year period is 26,000. If you think about the interest that you're going to save on that $50 per fortnight, it's actually about double. You actually double your money. So I did the calculation on this today, which is why I was hoping you would ask. And you would actually save double that $50 per fortnight. So absolutely. And I would challenge you to start at $50 per fortnight. When that next pay rise comes in, why don't we increase that 50 to 100? When that next child leaves home and your fixed costs drop down, we can increase it to 150. But if that's all you can find at the moment, just start, just do it. Great question.
Thanks, Shelley. We are looking at an investment property. Any advice on whether to fix or float or both?
Yeah, so with an investment property, and I've kind of probably covered this question off in the session tonight, if you have a home mortgage, please prioritize paying that off before you pay off investment property lending. The reason why is that the interest on the investment property lending is actually tax deductible against the rental income you're receiving on that property. So it's better for tax efficiencies if we park that lending, channel everything towards paying off your home mortgage, and then we can address that mortgage once you're mortgage free on your family home. For most of my clients with investment property lending, we're just into interest minimization. So let's just fix, definitely don't float on that, fix, and we're just trying to make that interest cost as low as possible, but prioritize home lending ahead of investment property lending.
Thank you. We've had another similar question come through. Say you have $300,000 on your mortgage, what percentage is a good start to be putting on revolving?
So the revolving credit is linked through to what you can save on an annual basis. So a way of doing this is sit down, get your Excel spreadsheet out, or get a piece of paper or a notebook. What is the amount that hits your account every payday as a household? sit down, understand what your fixed costs are, put in some allowances for family holidays or, eating out or, clothes and discretionary kind of items. See how much you've got left over or how much you can keep realistically. That is the amount that I would want you to put into that revolving credit. And the aim would be to make sure that you pay that back down to zero by the end of the 12 months. So the amount in the revolving credit, it's linked through to how much you can save rather than how much you've got in terms of your mortgage. So that kind of requires a budget to be done.
Thank you. What are the pros and cons of breaking a fixed rate?
Yeah, and this is one that we've got quite a lot at the moment in terms of our existing client base. So a lot of people freaked out when rates got up to that 7 or close to that 7% point. And for some of them, they actually fixed for a 3-year period. If they'd asked us, we would have said fixed shorter. Most of our clients wouldn't have fixed for 3 years, I should say, because we would have told them not to. But occasionally we'll see a client that maybe did that prior to coming to see us. So what happens now is the interest rates go down and they're going, oh my God, I'm paying nearly 7% for the next 3 years. So we've actually got a calculation that can be done, which we call the break cost calculator. So if you were to break and if you were to refix at a lower amount, how much would you save in terms of interest at that lower amount versus the break cost? And in bad news, the bank usually always get their pound of flesh. So generally, I mean, you signed a contract with the bank for that 3-year period, they'll charge you a break cost. And generally, the savings that you make on the lower interest rate, because of that break cost, it doesn't make sense to do so, which is why it's so crucial to get the right advice around your mortgage. And that's why we always say to our clients, just ask us in terms of fixing periods, break that mortgage down into savings targets, pay it off faster through that revolving credit, and then everything else we kind of fix for the appropriate period of time. So you can break, but often the bank will still win. I'm sorry. The only time, actually, I'll add to that, the only time that breaking is definitely worth it is if you somehow come into money or you get a bonus or you get a windfall. The amount that you're not paying on savings will be absolutely worth it, even if you do have to pay a break cost. So that would be my caveat there. Any more questions?
Awesome. Thanks, Shelley. We've got time for 2 more questions.
Cool.
The next one is, if we have an offset account and are saving a bit extra, should we continue to save it up and then pay off as a lump sum or pay extra each fortnight?
Yeah, so I don't like to pay extra each fortnight because the trouble with doing that is that you're increasing your fixed cost load. So what if something happens, you lose your job, you get made redundant, there's some sickness or some reason why you can't work, all of a sudden you can't afford your mortgage repayments because you've hiked them up. So I definitely recommend not increasing your mortgage repayments. If you're running an offset, really critical to understand that the portion that you're floating on that offset loan is equivalent to the amount of savings that you have. Otherwise, you're paying the floating rate over and above the balance of your savings. This is where I tend to not be such a fan of offsets. Ultimately, we just want to pay the damn thing off. So I would say pay that offset loan off using the savings, right? And it's gone, but then you have no buffer. So I think the revolving credit could work in your situation if you feel that you can control that. That would be my advice.
Thanks, Shelley. Last question, and this is related to consultations. Someone's asked, what exactly do we get from the consultation that's advertised?
Yeah, so the consultations are awesome. So we actually ask for quite a lot of information before the consultations. So it allows us to prepare, it allows us to understand your financial situation in quite good detail. We're going to ask you to give us information around your ages and how long we've got until retirement, the values of your properties, the value of your mortgage, and your income and expenses. So once you've inputted that all into our system, it gives us a really good idea of what we think you're capable of achieving. So what's involved in the 90-minute consultation? We're looking at, okay, this is your starting point. What are your goals and where are you trying to land ultimately in retirement? Then we give some key recommendations about how we think you can structure your mortgage, how much fritter we think you can find. And we'll come up with, if you've got a mortgage, we'll come up with a graph to say, hey, if you can stick to this plan, we think you can get mortgage free in X amount of years. So it should be quite accurate if you've inputted quite accurate data. So quite exciting. And one of the biggest pieces of feedback I get after those sessions is that people just feel really empowered. They feel like they've actually got a plan and they've actually got something that's going to get them ahead faster. So that's what's involved.
Thanks, Shelley. We'll leave it to you to wrap up.
Cool. Thank you very much. And I hope everyone online has enjoyed the session tonight. Please come along and see us. We'd love to see you for a consultation. Otherwise, have a lovely evening. Take care.